Hi, my name is Scott Deveau. I'm a deals reporter here at Bloomberg. Cover shareholder activism. This year, we saw one of the most interesting proxy fights that I think I've covered in my short time doing this, or long time, I guess. It was a first-time activist named Engine Number One, about a $250 million fund, took on Exxon Mobil, the oil and gas giant, and managed to win 3 seats on the board. It was a shock to a lot of people, but a lot of people also saw it as a watershed moment for so-called ESG activism, which focuses on environmental, social, and governance issues. We've got a great panel here today to discuss it. Obviously, there was a lot more to this fight than ESG, but I'll just take a minute and let everybody introduce themselves. Jennifer, would you care to start?
Sure, Scott. Great to be here and looking forward to talking about this particular topic. I am the CEO of Engine Number One, and we started the firm at the end of last year. So look forward to speaking with everyone here today.
My name is Aeisha Mastagni, and I'm a portfolio manager in the Sustainable Investment and Stewardship Strategies group of the CalSTRS Investment Office. We're the $300 billion pension fund for the California educators and their families.
And Lorraine.
And I'm Lorraine Kelly. I head the governance solutions business at Institutional Shareholder Services. We're an ESG company, probably best known for our governance and research and voting recommendations. Also a pleasure to be here today to speak on this timely topic.
Great. So I think it's important that we establish some of the background at Exxon in order to understand what really happened there. Aeisha, CalSTRS has been a long-time investor in Exxon. You've had lots of discussions with them in the past. Would you be able to give us some background as to why you think that maybe they were in a position to lose such a lopsided battle proxy fight?
Sure. So at CalSTRS, we do have a long history of engagement with this company. And I think there were some key milestones along the way that led us to partnering with Engine Number One in terms of trying to get new leadership inside that boardroom. You know, the first was starting back in 2017, there was a shareholder proposal asking the company to present a report on the risk of climate change to their organization. That proposal actually passed by a majority support, so it was widely accepted and wanted by several investors and shareholders. But the company basically ignored that proposal. You sort of fast forward to the 2018-2019 time period, and organizations like Climate Action 100, which is a collaborative group of investors that are engaging the largest global emitters of carbon and trying to get commitments from these companies in order to make their organizations more resilient as we transition to a low carbon economy. And Climate Action 100 couldn't achieve any type of commitments or reductions from Exxon. Fast forward again to the 2020 annual meeting, CalSTRS actually decided, because of the lack of responsiveness from the company and from the board, we voted against every single member on the Exxon board in 2020. So it was a natural progression when Engine Number One brought this idea to us about really making a change inside the boardroom.
Okay, Jennifer, I've heard you refer to the strategy you adopted at Exxon as being the tip of the spear. Obviously, you didn't have a big investment in Exxon, but you obviously had a very large impact on what happened there over this proxy season. So I wanted to ask you, how did you know that you had the right company and the right ideas?
Thank you. I mean, we put together the company, so Engine Number One, where the whole idea for us is, companies and boards and CEOs have a responsibility to understand their industry, how their industries change over time, and how you respond to these changes. So Engine Number One as a firm is all about looking at companies and looking at their impacts and thinking about how do they take those impacts, into account in terms of driving their long-term value. And so if you think about that idea, Exxon, as Aeisha said, Exxon is a place where the industry they're in is changing, and it's changing because technology is changing, tastes are changing, regulations, all of the above. And so we thought about Exxon as a place where change needed to happen. And how does change happen? You have the right people on the board. And so it was natural for us to make the case and do the work on the analysis and how do you think about it and what were the skill sets that were needed on the board. But it also made sense for us to partner with organizations that, as CalSTRS has been doing, as Aeisha mentioned, have been working on this with Exxon for a number of years. And so in a way, in this case, we did the work on what change could look like and what skills were needed on the board. But then as we went out, we could be the tip of the spear as a new firm in making this case, and frankly, bring other large investors with us.
Well, that's the interesting thing, too. I mean, you did garner the support of some major institutions outside of CalSTRS, BlackRock, Vanguard, State Street, and all of these institutions are clients of ISS. I mean, so what surprised me about this fight in particular was that ISS and Glass Lewis also threw partial support behind engine number one in this. Without going into too many details, Lorraine, would you give us an idea of how ISS is thinking about these kind of ESG issues, versus, say, capital allocation, and which, carries more weight?
Well, I think, Scott, first of all, from our perspective, ISS opines on the agenda items that are on the ballot. And what I think you're hearing and seeing is we're getting more situations and more agenda items that are ESG focused on the ballot. In the case of Exxon, I think we saw both. We primarily saw the capital allocation issue, but we also did see that Engine 1 made a very good argument for sustainability and for the need to change. So I think at Exxon Engine 1, you really saw both of those issues coming together. In terms of how we weight them, it's very situation specific, and you really have to look at, really everything that Aeisha brought up in terms of what is the history, everything that Jennifer brought up in terms of what is the current situation in order for us to come forward and provide a recommendation to the marketplace.
So Jennifer, you're not just going to stop as an activist fund. You've recently launched a new ETF that has a similar kind of bent on ESG issues. Can you tell us how your ETF is going to differ from a typical S&P 500 ETF?
Scott, thank you. Yes. So at Engine Number 1, we think about it as being able to work in different ways with different companies and also provide access to different clients. So, why an ETF? Well, there are a lot of people that are looking to track the market, and you may be tracking the market just to drive returns, but people that want to have impact and want to help people, companies, think about how they drive to long-term value. They want to be active owners of these companies, and they have a vote. I mean, definitionally, if you're holding an ETF or a mutual fund, you own those shares, and you have an opportunity to vote those shares by choosing a manager that's doing that actively. And so one thing that we can do at Engine Number 1 is we can do an economic and impact-oriented proxy campaign and an activist campaign like what we did with Exxon. And we launched the Vote ETF. There's a little clue in the name there, and we gave it the ticker vote. We launched this ETF because it's a way for people to stay invested in these big public companies over time. And then we, as the manager, will vote very actively. So instead of meeting in the middle or taking many years to get to a point of view, we'll be very assertive in looking at each company and using those votes on behalf of the shareholders to vote on issues each year. And then the ETF can also participate and take advantage of engagement campaigns or activist campaigns that the firm does over time. So we think it's a good way for people that want to hold companies accountable and be invested for a long time to also be very active on E, S, and G issues as owners of these companies.
So how will this work practically? I mean, will you be putting out papers or recommendations ahead of a vote with the idea of maybe persuading others to vote in a similar manner? Is that the idea, or?
Yeah, so at engine number one, we certainly will have a point of view and we'll publish. But like in the case of Exxon, we will be more effective if we're working with coalitions of other large investors and pools of assets on these issues. So yes, we'll be active in telling everybody how we plan to vote and talking about why and putting content out there. But we also plan to work with other people on these issues because we think, like in the case of Exxon, coalitions on some of these issues to not always to be activist in an aggressive sense, sometimes, frankly, to be constructive and help companies think about how these impacts affect them today and how they'll affect these companies as they go through transformation over the next 5 to 10 years. So both active in publishing and having a point of view and voting aggressively and working with other big institutional investors. That's a critical part of our strategy.
And I can chime in here.
Sorry. Yeah.
No, I was just going to chime in because I think that, we as investors, that we have a whole suite of tools available to us in order to effectuate change. I think it starts with that vote, like Jennifer was talking about. Then there's private and public engagement. And then you sort of go to the other extreme, which is, the case with Exxon, where you're actually running a public campaign to replace board members. And there's lots of things in between. And so I think it's just taking advantage of all of those tools that we have available to us as shareholders to make change and make these companies better and more resilient for the future.
Well, that's what I was going to ask you as well. I mean, it seems that that CalSTRS is one of those funds that actually they disclose their where they're going to vote ahead of a vote generally to give an indication of where you're going. So it seems like you're doing something similar to what this ETF contemplates. But I was curious, like, why don't you run campaigns yourself as CalSTRS if you have views on these things?
Sure. So we definitely do post our votes. We try, not only because we're a transparent organization and a public entity, but we try to use our votes partially to help inform the marketplace. If anyone wants guidance, it's available on our website. As for the public campaign, engine number one, what they really brought to this was the core, fundamental analysis and the ability to partner with various consultants, the ability to source the quality candidates that we found. That's not our role. We just don't have those resources. And so engine number one really brought the resources to run a campaign of this scale. I think what we brought to the table was, one, our long history of engagement with this company and, our long-term capital. We're not short-term. We're here because we want to provide a safe and secure retirement for our beneficiaries. And so I think that's why the partnership it works so well.
So Lorraine, ISS is in a really good position to monitor these kind of shareholder proposals as they're presenting themselves, and the uptick in ESG proposals. What are some of the trends that you're starting to see over the last year or two in terms of the proposals and how shareholders are reacting to them?
Yeah, great question, Scott. So 2021 was a really breakout year for ESG and shareholder proposals. If we look at the top line numbers, in the US alone, we saw about 500 proposals this year compared to 445 last year. And the majority support is already up 46%. if you drill into climate, I think this is where it really gets interesting, because it seems very clear that many shareholders are holding the boards accountable for risk mitigation in the area of climate. So we saw a record number of proposals in the climate space, and there was really three flavors. So the first was reporting, requests for proponents wanting a report on your plan for reduction of emissions, perhaps aligned with the Paris Accord or with a net zero initiative that we've heard mentioned. We also saw proposals on lobbying spend, where proponents want to know what are the expenditures going towards climate lobbying. I think it's certainly notable here that a number of those proposals got majority support, with Exxon being one of those. They certainly weren't alone. We did see United Airlines and Delta Airlines with them and a few others. And then the last proposal category we saw was a new type of proposal this year called Say on Climate. And so if you think back to the Dodd-Frank days, a little over 10 years ago, when the SEC mandated companies to put CEO pay packages up for review, this is somewhat analogous in that the proponents are asking for a report on your emissions and your plan for climate, and then they also want to vote on it. So I think what we are seeing is multiple ways within shareholder proposals to really express those voices and views. And thus far, we've seen, I think, 12 of those proposals get majority support. So again, a trend that we see moving forward for sure, with investors looking closely at shareholder proposals and how they can, wield their voice.
Well, I would open this up to everybody. I'm just curious why now? I mean, Lorraine, do you have a sense of that, or Aeisha or Jennifer, why now?
Yeah, I think when I look at it from our view and the metrics on the climate shareholder proposals and the support levels, if you look at 2017, you've seen an average support of 27% to now an average support of 58%. So it has been gradually climbing, but I do think this year was very, different. We noted Exxon, we noted the participation, but we've also had a lot of investment managers really publicly pledge that they are going to commit to a lot of these climate initiatives. Many of the investment managers and certainly the asset owners have signed this net zero initiative. And so now it's about, walking the walk. And I think that's what we've seen through this Exxon, Engine 1 scenario is, as you noted earlier, a lot of the large investors voted to support Engine 1. So I think that, there is a real view that these are not special interest issues, that these are real material risks to these companies.
And
right.
I'll just add that I think it's really about, the links between climate change and financial performance are just increasingly intersecting. And there's a recognition by the broader marketplace, like Lorraine said, that recognizing that and really wanting to make sure that the companies that are part of their portfolio are going to be resilient in a changing world.
And Jennifer, I mean, you must have some thoughts on this too, because you launched a fund with this kind of focus. There are certainly, there are a couple other ESG focused funds, but it's still a pretty small group of investors that are focused on these types of things. Do you have a sense of, why now?
Yeah, I mean, I think to build on what Lorraine and Aeisha said, the why now is, I think you have organizations that care about the long term. You have wealthy families, you have millennials who have a genuine concern about sustainability. And at the same time, I think we're doing a better job across data industries and the investment industry of linking with data these impacts and the climate impact to the pure economics of how companies will perform and thrive over time. And so I think it's the combination of a desire to be thinking about sustainability of businesses and planet, but also a lot of work to make sure that these become economic issues. We can use data about carbon footprint and how businesses are run and how they're planning their forward years, and we can turn that into economics. And I think people can agree when it comes to economics that there's a better way to run a business sustainably over time. So I think that's all coming together. And for us, that was part of why we think this is a moment in time where we were successful, together with other institutional investors on Exxon. But that's also what drove us to launch the Vote ETF, because it's not a divestment-oriented product. It's a product, so a lot of early ESG funds change the weighting or divest from certain stocks. And so we think that now is a moment in time where people they want to hold the big companies. They want to help the big companies transform, and they want to link economics and sustainability. So that's sort of why now for us on launching this Vote ETF.
So the other thing that I found kind of interesting about the Exxon fight, Jennifer, was how many different investors came forward and said that they supported you in advance of the vote. Lorraine, have you been noticing more investors coming out in advance of votes? I mean, we talked about it a little bit earlier, but it seems like it's something that's happening more and more.
Yeah, I think that and the ISS view is very notable about the situation with Exxon, because I think investment managers have tended to hold their vote decisions close to the vest and really wait until their regulatory filings, whether that's with the SEC or whether they're doing other types of stewardship reporting, to disclose this information. I know, Aeisha, your organization with CalSTRS, you guys have disclosed in advance for a long time, and many other asset owners have. But the investment managers, I think this is newer. So with Exxon, we did see Legal & General coming out in May saying they were supporting Engine 1. And then on the day of the vote, I think it was both BlackRock and Vanguard, issued their statements that they had some support for Engine 1 and provided detailed analysis on their decision. So I think these are definitely watershed moments in that regard. And we definitely hear from more investors that they want to do that. And so, we've been working to evolve some of our tools within our vote disclosure service to help facilitate that. But I think it ties back to something that Jennifer said earlier, which is people do want to own these big companies. And so they're looking at ways that they can help affect that change. And certainly using their vote and using that voice is one of them.
Jennifer, was there anything that you did differently, or that would elicit these kind of investors coming forward, or was it motivated internally by them, or was it something that you urged them to do yourself?
I think to go back to something that Aeisha said, two things when it comes to Exxon. One, a lot of institutional investors were already talking to the company and working with the company and looking for change. Two, it's easier for big pools of assets to have a conversation with a company if it's an economic and strategic discussion. And so for us, jumping into a conversation that was happening and trying to provide a set of data and analysis, and the team on our side at Engine 1 talked to other CEOs, other boards, talked to people about what were the skills needed in terms of CEOs that had led successful transformations in the past. How do you lead a company through change? Having the right skill sets in the energy industry to help Exxon. And so going in, we were able to do some of the analysis and the work to try to suggest how you might augment the board and what the right skill sets might be. And so I think that was frankly additive at a moment in time where a lot of other institutional investors were looking at it. And then, yes, in an example like this, there is a degree of making sure you're being persistent in having conversations with everybody on the way into the vote.
So I think a lot of people are going to probably look at this fight as a template for things that they want to do in the future. I'm curious, what your recommendations are for them, because, there was an ISS report that came out last week in another fight that said, ESG issues can't be a talisman people whip out whenever they want, in the middle of a proxy fight. So I'm curious, what were the lessons learned here that other funds might be able to adopt and take to different companies? Aeisha, do you have any thoughts on that, or?
Well, I'll just to go back to what Jennifer was saying too, this was successful because there was a sound argument and the credible directors that they sourced to put on this board. And so I think that's really the lesson learned here, because, we start out at the beginning with engine number one talking about, where's the path to value creation? And because we wouldn't have done this and we would have invested the resources in this unless we thought that there was value to be had. And so, engine number one brought that sound financial analysis and what we thought was strategically this company needed to do in order to create that value, and then going to find those individuals that we thought could help drive that value inside the boardroom. So, I think that's really the playbook. It happened to be, that this was a company that had severely underperformed the market and its peers for 10 years. It had been quite recalcitrant when it came to engagement with its shareholders and investors. And so all of that led us to, this monumental vote back in May.
Jennifer, do you have any thoughts on or advice that you might offer other funds?
I think Aeisha summarized it well, which is, to think about it as an economic argument, and then to bring ideas that can help the company have the right skills. And, listen, there are probably every industry is going through a huge amount of transformation in the next 10 years. And so thinking about what does a board need, what skills does the board need, what capabilities does the company need to be able to transform and to make it an economic argument. That would be my advice.
Okay. We don't have a lot of time left, but I do have one more question. In the middle of the proxy fight, Exxon decided that it was going to do a number of steps. It started trumpeting its carbon capture mechanisms. It essentially added 3 board members and then promised another 2 directors after the vote. Was there a point that you considered declaring victory based on those things, or why did you keep the pedal to the metal on it, as it were? Jennifer.
Yeah. I give you my take on that, which is, we thought there was a case for change to drive value for shareholders, and so making sure that we sort of saw it all the way through to make an argument for the right skills and the right directors to be added to the board. And until we got to the point where we thought that had been achieved, we were still in the fight. And we think we got to that place, and look forward to seeing what the new board with the new directors can accomplish in terms of long-term value for the shareholders.
Aeisha, Lorraine, do you have any other thoughts on why that wasn't sufficient, either to not garner support from ISS or CalSTRS?
Yeah, no, I'm happy to jump in here because like I said, we identified, the path for value creation, and then we identified the skill sets that we thought were necessary in order to achieve that. And it really was around, this was a board that needed more industry expertise. It needed policy making and regulatory experience, and it needed individuals that had gone through this at other companies that were in transformation. And while I think that the 3 board members that Exxon originally added filled some of those holes, it didn't do it in the critical mass the way that engine number 1 directors did. And so, we stayed true to the course because we knew that these were the right people with the right skill sets in order to achieve that value.
All right, Lorraine, we just have a few seconds left. Do you have any thoughts?
I was just going to, comment that I didn't want to talk as much about that particular thing, but I do think that companies are responding as well. And when I talked about the Say on Climate proposal earlier in this session, we saw globally about 20 clients put that up as a management proposal themselves. So I think that all of this activity is moving the dial with our companies as well as with investors, and that's a good thing.